Go to Webinar Control Panel to allow all attendees to hear you. This system will notify you once you begin your broadcast.
Hello, Mike.
Hello.
How are you?
Good news, Ray.
Good. Thank you. I've got you on board, and we're waiting for one or two other people to come online now quickly. So we'll just give them a couple of minutes, and then we'll get started. Can you see my screen?
Yep.
Okay, cool. So just give us a moment. Let's see if the other people log on. You got that guy. Smith.
It's actually really powerful. I can just give it a minute.
Okay, we're just going to give it 2 more minutes.
Hi, Rob. Okay, Chris here from OnePoint, right?
Okay, so we're just waiting for one more person who says he's logging on now, and then we'll get started. Hey, Mark, is your mouth full at the moment?
No, I'm good to go, B.
Good to go. Okay, cool. We had only a very few people coming online for this webinar. So we're just waiting for the one other guy to log on. Michiel just spoke to him now. He says he's logging on right now. So
Okay.
I'm going to get started any second as soon as he logs on.
No worries.
Cool. How's things down there in Cape Town?
Glorious day.
Glorious. That's wonderful.
Mm.
Can't wait to be down there.
Is it happening?
Yeah. We've just got to work out the details after the baby's born.
Awesome.
Yeah.
More fish fries.
Yeah.
Are you using the mic on your keyboard? On your
On my
computer?
computer.
Okay.
Yes.
It's crystal clear. I can hear every keystroke.
Oh, really?
And I think if you turn around and look in the back corner there's a cockroach. I'm sure I heard it crawling around there.
Yeah. That's Michiel. He's not a cockroach.
How's it, Mike?
How's it?
Have you guys met before?
I think we met the Billionaires Breakaway, isn't it?
No, I haven't been on that.
Oh, yeah, then I haven't.
Well, you're both Hannes students, so I'm sure you'll get along just fine.
Good stuff.
Just checking with the one other lady that's supposed to be on too. I mean, there's about 4 or 5 people that are supposed to be on, and so far it's just you and me and Michiel.
Okay.
Yeah.
But you said there was going to be another one
Yeah.
tomorrow. Eh?
Rob, he should be coming on now.
Yeah, it might be the time of the day that's
Yeah.
causing a bit of an issue.
So I'm going to give him 1 more minute, and then I'm going to get started regardless. Wow, when you're watching a clock like this to wait for 1 minute, it feels like a long time.
Watching paint dry.
Yeah. Okay, Rob's going to have to catch up, and so is Micheline and Amanda. I'm going to get started. So, Mike, if you have any questions, just shout, because it's us three over here. Michiel's going to kind of drive it. As you can see, this is the brochure that the sellers provided to us on the 7 medical buildings. Where they're situated is in Atlanta. Where's that little map down there? Yeah, over there. So if you fly into Atlanta, the airport is about here. And this is about 15, 20 miles south of the airport. So the 4 of the buildings are here. Sorry, not 4 of them. 6 of the buildings are here along this little stretch. And then 1 of them is up north here in Blairsville. That's the oldest building out of the entire portfolio.
I saw the picture.
Yeah, so the doctor started with that one, and then they started building out here.
Mike, the other thing which is significant is that that Peachtree City, that whole area is pretty much a medical clinic area, and there's quite a long.
I did see it at the at that presentation you guys gave in Cape Town.
Okay, so you still remember some of that stuff. basically
I do
about
remember
$500
it quite
million
well,
dollars
yeah.
spent along that corridor of medical.
Yeah.
So if we have to start looking at what they offered to us and where we ended up, just to give you a summary, we don't need to look at the pretty pictures. I mean, there's some of the buildings, and they got all these fancy graphs on tenant growth and all that type of stuff. What we really wanted to understand was the numbers. So Michiel and Bruce and Paul have been working together to put these numbers together. So how everybody fits together is Bruce is a friend of Amanda's. Now, Amanda was actually supposed to be on this webinar right now. She's one of the investors in one of the Wealth Migrate projects already, and she introduced us to Bruce. Bruce used to be a South African. He's now an American. He's been there for about 15 years. He's a CPA, and he primarily operates in the residential multifamily home development side of things. But he wants to exit that and start working with us full time. And he presented this deal to us from one of his ex-partners, Paul. So he used to work for Paul. Paul has a company in Atlanta that specializes in managing commercial buildings, but primarily managing medical buildings. So he has a particular skill set that's valuable to stand as what they call a sponsor. So a sponsor is somebody that puts up his name in order to acquire finance in the States on behalf of the project. Their downfall is cash. He doesn't have $5.8 million to actually raise to put this project on the table and actually complete on it. But he does have the financial track record to qualify for the finance in order to buy the buildings. So he puts up his name and his financial record so we can get access to finance. And he also then manages the buildings on our behalf going forward. And he earns a fee for that. It's about 3.5%. So based on the information that we were able to glean from Paul and from the sellers over the last 2 months that we've been working with each other, this is the what they call a pro forma, just the basic spreadsheet that starts telling us a little bit more about how we actually get paid and what our risk is, where we stand on the entire project. And as you can see there, I don't know if it's clear on your screen, Mike. Just let me know if I need to blow it up a little bit.
No, I can see.
You can see, okay. So the purchase price is $14.75 million. So what happened there is when we started looking at buying it was $14.5 million. But a big section of the property portfolio was vacant, about 13% of it. So we needed to then place tenants into that 13%, which meant that we would have a tenant installation fee that was quite hefty to place those tenants. And as a result of it being vacant, we could use the cap rate. I'm not sure how much you know about commercial property, Mike. Just tell me if just step into the question.
Very little, Brendan. Very, very little.
So what they do to work out the value of a property is they reverse engineer it from the actual income. So you'll see here on the right-hand side in row H, there's a cap rate going in of 8.2%. What that means is the net income at 8.2% gives the property a value of $14.7 million. So they work it out in a reverse transaction or a reverse calculation to give you an idea of what the value is of the property. So, for example, if this cap rate had to go down, the value of the property actually goes up. So if we go down to a 7% cap rate, it means the property's value would then be at about $20 million roughly. So you can influence the capital growth by adjusting the income figures. It's also a very, very powerful negotiation tool because if we have to have a look at what they did in order to get to a 14.7 million purchase price, is we managed to find another tenant for that 13% that was vacant. And that tenant happens to be Piedmont Hospital Group, Piedmont Medical Group. They're one of the top 5 hospital groups in the US. So it's a very good quality tenant. And they took quite a large portion of that space. They actually took all of it. Which then meant that we're at about a 99 or 98.7% occupancy rate, which is really, really high, which is fantastic. But if it's that high, it then means the seller's now sitting in a position where they can measure the value of the property at a much higher value because they've obviously got more income coming out of the property with the new tenant. So what they did is they said, well, the tenant can move in and we'll give him free rent for 5 months. So for 5 months in 2015, we actually don't receive any income from that tenant. But what it does, so it influences our cash flow in the first 5 months of placing the tenant. But because they're not measuring that cash flow on the purchase price of the property, it meant we could get it at a huge discount. So what should have happened is the price of the property would have gone up to about $16 million. But because we didn't take into account the 5 months, we were able to keep it down to about $14.75 million, which is pretty phenomenal. It meant it went up slightly from 14.5 to 14.75, but our risk went down massively because we've got a really, really good quality tenant that's now taken up that space. So if you have a look at the numbers here, what we are doing is we have to raise roughly $5.6 million for this project, excluding working capital, including $120,000 of working capital just to have a buffer in the account in case anything goes wrong or we need to place anything or fix anything. We have to raise a total of $5.725 million, which then means we are financing of the purchase price with all the acquisition fee, because we're paying Paul's company a 1.5% acquisition fee for sourcing the property, then all the closing costs and legal fees, the percentage split that we have to pay commissions in order to raise the money is built in over there, as well as the tenant installation costs for that new tenant, which is about $500,000. So we actually have to pay to build out the space to suit that tenant. And then the closing costs and legal fees. So that brings us to a full purchase price of roughly $16.011 million. Off of that, we're financing about $10.4 million. And of that, now we can actually start looking at how to calculate the internal rate of return. So if you've analyzed any properties with Hannes' software in the past, you'll know that the internal rate of return is the number that benchmarks anything against anything else. And generally we want to look for infinite rate of returns if we're looking for projects in South Africa. But because this is an equity raise of obviously we're going to be measuring against the equity how much money we're physically putting into the project and how much money we're physically getting out. And that gives us, as a project total, a 21.8% IRR. And that takes into account quite a few variables. The variables are often, we've got a 5% vacancy rate that we're taking in. So even though we're technically fully tenanted at 98 point whatever percent, we're taking a 5% vacancy rate into account in the cash flow anyway, just so that we've got a very conservative view on the whole project. Okay. If we have to have a look at the actual investor returns, because that's ultimately what we want to know. We want to know how much does the investor get paid at the end of the day. That's you and me and everybody else that's physically putting money in. We just need to open that up a little bit. You can get an idea here of the cash flow and the distribution. So as the rental income comes in, how it's going to work is every 3 months we have to submit to the lender, which happens to be the Royal Bank of Scotland. We have to submit the financials to them so that they're happy with where they currently stand on the entire project, and they can see that we're actually managing it properly. So every quarter, it then means we can do a distribution to the investors. So once every 3 months, we'll then be paying out. The cash flow for distribution is $493,000 in the first year. Of that 493, the first 8% return, as you know, that's how we've worked on any income plan model in Wealth Migrate. The first 8% goes to the investors. Anything over that 8% is then split 50-50. So this 458,000 is the 8% on the 5.7 million that we put in. So that first goes to the investors. That then leaves a profit of roughly $35,000. That's split 50-50. So the investor gets 17,000 on top of his 458, which gives us 475,000 that goes to the investors. And this is obviously an annualized thing. So if you want to know per quarter, just divide that by 4, roughly. Which then gives an income distribution of roughly 8.5% in the first year, and it goes up each year. reason it goes up is because we've got an escalation clause in all of our leases of about 3% a year. And then Wealth Migrate gets $17,000 out of that income. So that's our split of the 50% over and above the investors' 50%. So that shows you quite categorically exactly how much money the investors will get paid out and exactly how much money we'll get paid out. So basically, for every $100,000 you invest in this project, there's going to be an $8,500 payout per year in terms of income. Then in the last year, in year 5, so our intention is to exit this and sell it out in year 5. We obviously make a bit of a capital growth, which is calculated on a 7.2% cap, right? Because the industry standard, if we have to go back here and look at some of the information that was furnished to us, just want to find it here quickly. It's a whole different way of looking at and thinking about the growth on the properties. It's not driven by the growth in the area. It's now driven by the actual the income. Just want to find those percentages. Can you remember what page they're on? Okay. Oh, there we go. So now the research tells us if you have a look at similar buildings in the area, we can see that the cap rate there is 6.8%, 7.13%, 7.25%, 7.5, 7.42, and 7.25. So by us being able to buy this property at 8.2% means we've effectively got it at a discount of about 13%, because we should be buying it at about a 7.1 or 7.2% cap rate. So based on those figures, if we sell out in 5 years' time at a 7.25% cap rate, then it gives us this profit in year 5, roughly $4.7 million. Of that profit, we do the standard 8% distribution to the investors. The balance is the super profit, and then that's split 50-50. So what it means here is in year 5, this is where Wealth Migrate actually makes some money. We stand to make a roughly $2.1 million on the exit of this project, which then means obviously we've got an incentive to make sure that we do sell within 5 years. Some investors are saying they'd like to stay in for a little bit longer. And what would then happen? Would they want to buy us out? Would we want to cash out? And we just made a decision that we'll go with, if 75% of the investors want to continue with it, we'll continue with it, and we'll wait for our cash out, or they can refinance the property and then release us from our profit without any further profit due to us once we've been bought out for the next 5 years. And there is quite a substantial chunk of capital growth in order to allow us to refinance in year 5. And that's where we start looking at the exit strategies. So here we can start calculating more or less what our equity value will be and how much we can cash out in year 5 or redevelop. Yeah, I mean, if we're able to take equity out and then develop or buy other buildings, etc., we can grow the portfolio organically from the portfolio's creditworthiness and income without having to call on the investors again. I see Rob Smith has just joined us. So I'm just going to unmute Rob for a second there. Hi, Rob. You're online with Michiel and Brendan and Mike Walsh and Willie LaRue.
Oh, thanks. Nice to hear you. I've had problems with the internet. I'm in Zimbabwe at the moment.
Oh, sorry to hear that. No, sorry about the internet. Not sorry that you're in Zimbabwe.
That goes with the territory. Don't worry.
Okay. So I'm not sure how much you heard or how much you missed, but I wanted to just if I can recap quickly, briefly on this particular project, is
okay.
It's a portfolio of 7 medical buildings in Atlanta, which is in a gateway city. So there's a couple of criteria around the reason we're very, very happy to do medical in the US. One, it's in the US, which means we've got a dollar-based return. The second thing is it's in a gateway city, which is an aerolopolis, basically a city that receives and distributes people in and out of it. And Delta Airlines is the primary reason for that. They're the biggest airline in the world, and their head office is in Atlanta. They've also got about 75% of the Fortune 1000 companies have a head office in Atlanta. So there's a very strong economic base to support the entire city. Their population growth is roughly 60% higher than the national average at 1.6% per year versus 1% per year. And it's pretty much because of the climate. They have the snowbirds over there that move south from up north. They've also got a very strong tax incentive for people to move down south, and a really good lifestyle in terms of affordability. So you can buy more and better lifestyle with your money in Atlanta than you could, for example, in New York for the same amount of money. So as a result of that, they have a very strong population growth in the demographic that we like, which is the 35 to kind of 50-year-old people that are adding value to the economy. The next thing on the list is it's medical office suites, and medical has been determined as the number one real estate industry sector for the next 12 months in terms of stability and growth, purely because of the amount of demand that is coming through in the US market for a couple of reasons. One reason is the amount of baby boomers they have. So baby boomers are the people that were born sort of around 1940 to 1950 that are now turning, they're reaching that retirement stage, and they reckon about 10,000 baby boomers are turning 65 every day in the US. Now, all of those people are going to require medical care in the very near future, and the medical care is going to be extensive and it's going to become more expensive. The second thing that's created a huge growth forecast in medical is Obamacare. So Obamacare has pretty much created a new client base for private clinics and medical institutions. With an influx of new clients, it means their cash flows are going to grow, and it means they're going to need more space in order to service those customers, especially if they're at breaking point already. So community-based hospitals and medical suites are in exceptionally high demand in the US right now, and in Europe too, but primarily in the US because of all of those reasons. And if anybody's interested in the research that backs that up, you can actually download it by logging into the Wealth Migrate website and just going to check out the Oak Hill project. All the documents are on the right-hand side of the overview page on the Wealth Migrate website. If that's too difficult to do, just drop me an email and I'll send you the links for the research that backs all of that up. On this particular project, I was just talking to the other guys online now. Our acquisition price is $14.75 million, plus the costs in order to close brings us up to $16 million. The equity we require to complete on that is $5.6 million, so that's the equity we're raising. On top of that, we're raising an extra $120,000 just for working capital for the project. When we first started negotiating to buy this, there was about a 13% vacant area. During the negotiation phase, we placed a tenant. The tenant is Piedmont Hospitals. Because of the quality of the tenant, the seller wanted to bump the price up substantially because obviously based on the cap rate of the property with the new tenant, they wanted a bit of a kicker on top of the $14.5 million that we wanted to pay them. We managed to negotiate it right down to $250,000 as their bump in price, which then means we're buying it at about an 8.2% cap rate going in. The industry recognized cap rates right now are between 6.8 and about 7.25%. So we are effectively buying it at a discount. Sorry for repeating myself here for some people that have heard this already. The support that goes with this cap rate at 6.8 to 7.2% is in this document over here, but it's also in other research that we've done where we can see the trend is actually moving towards a 6.5% cap rate over the next 5 years. And we've worked very, very conservatively on our figures to work out our exit prices and our refinance prices, etc. And that exit assumption is here at 7.25%, which is what the industry standard is right now in that market, in that local area. So based around this information, we were able to get finance on this project at 4.13%, amortized over 30 years with a 5-year call. So basically it means we've got a 60-month loan at 4.13% fixed. It's non-recourse finance, so they can't come after the buyers if any of this goes wrong. And also South Africans or foreigners, I know in South Africa, I'm not sure in Zimbabwe, but we can't take on finance that is recourse finance if it's outside of South Africa. So with regards to the numbers and the investor returns, Rob, did you hear any of that information when I was going through it a few minutes ago? Or would you like me to just start from scratch again?
Yes. No, I've got that. I've got about 98% of that. That's fine.
Okay, cool. So this is the very important part. It's how much are you going to get paid and how often are you going to get paid and what's the exit plan? So in terms of income, we've split the two, the capital growth on the exit as well as the income, so that people can see exactly what's actually going to land in their bank accounts. And the investors are going to get the first 8%, which is the preferred return on the equity, which is the 458,000. Then the profit on top of that, after the income, measured at the 493, is 35,000. That is then split 50-50. So 50% goes to the investors and 50% goes to Wealth Migrate. And that's how we make our money. On the last year on exit, you can see that our capital gain is about $4.7 million. And then the distribution gives us our kicker, and that's where Wealth Migrate stands to make some money out of this project over the term of the project. We looked at some of the exit strategies and what the impact would be on when we could possibly refinance to grow the portfolio, at what levels we could refinance at, and if any of the investors wanted to exit in year 5, what kind of money would we have to either call on investors for or pay out via a refinance without it affecting the portfolio too much. And these figures are down here at the bottom here. So if 25% of the investors want to be cashed out, we need roughly $2.5 million with Wealth Migrate and the investors to be cashed out, to be taken from the project portfolio to buy us out in that year 5. We are quite happy as Wealth Migrate to continue with the project if the investors do want to continue from year 5 on. And we can see here on these figures that it does become worthwhile to stay in the project at a certain point. But our mindset is always growth. So we also want to start calculating at what point can we extricate some extra capital from the project in order to either develop or grow the portfolio during the lifespan of the project. And we can see here around year 3, we can actually see we've got about a 47% equity ratio, which means we could effectively source about $3 million in year 3 on the same 65 to 70% loan to value ratio of our properties. So if we could get $3 million, we can then either pay out investors if they wanted to be paid out from year 3, or we could roll that into growing the portfolio, add more buildings to the project without any more risk, because we're not laying out money out of our own pockets. In terms of where we stand right now, we've currently raised, as of this morning, we met with another high net worth individual who's putting $1 million behind the project. Michiel, what is our total that we're sitting on right now?
5.02 million.
5.02 million. So that's where we stand right now on our capital raise.
So we've got a gap of
about $700,000 that we're trying to close. The reason we have that gap is one of the investors, his name is Colin, is an accountant, and he simply can't access his money in time in order to complete on the timelines. The timelines are fairly strict. Our deposit goes hard. So in the US, that term basically means that the deposit that we have on file with the attorneys right now, the $75,000, would be non-refundable after the 1st of August. So we've got to have our commitment letters and our $5.7 million in a bank account prior to the 30th of July in order to complete on this project. In terms of the due diligence, we have a 140-point checklist that we've gone through. Is that checklist in our Dropbox folder?
Yes.
Just show me where it is quickly.
It's right in the top directory. There's a due diligence.
Oh, okay. Hold on. This one.
Yeah.
So this is our checklist of the due diligence points and where we're at with everything. So if you get an idea of what we've gone through to get to this point to actually say yes on the project, you can see, I don't know, it might be a bit small. Let me just blow that up a bit. We've looked at the lease agreements, how often they renew, what the renewal clauses are, what the potential is of them not renewing. We've looked at the title deeds. We've looked at the zonings. We've had physical inspections of the properties by building inspectors. We've had quotes on replacement value by builders in the local market that build medical buildings. We've had a look at the structure. We've had a look at all of the utilities. We've looked at a hell of a lot of stuff in order to give the nod on this project. And we've reached a stage where the stuff that is still outstanding, for example, a copy of the insurance debit note, we can't get that until we're actually in closing. So we can only get the insurance note once we're in the process of closing on the project. The sum insured, we obviously can't get that until we've got the insurance note. So a couple of the items that are still outstanding are simply outstanding because they're part of the closing procedure. And you get an idea of what, an unexpected error has occurred, of what we've had a look at in order to give the nod on this project. We've given the nod on this project, so we're happy to proceed. And any investors that want to participate would then have to sign a commitment letter. The commitment letter then tells us what amount of money they want to move to the attorney's escrow account and by when it will be there. And then part of that commitment letter is a commitment from our side to furnish the investors with all of the agreements that then tie up this deal. So to give you an idea of how it's structured, effectively, all the investors pool into one LLC. An LLC is a limited liability company, which is a financial holding instrument and an entity in the USA, registered in the USA. The investors pool their money into there, and then they own the share in the property LLC that then owns the actual properties. So that limited liability company is the holding company, which owns the properties. And then you'll see here the sponsor owns 50% of the equity too. So the sponsor is the guy who's putting up the debt. He's also putting in a little bit of cash, and he's also managing the buildings for us ongoing. And on the right-hand side here, you can see the diagram for how the cash flow is distributed. So even though there's a 50% ownership here by the sponsor and a 50% ownership by all of the Wealth Migrate investors, the cash flow distribution is still worked out on the basis of the investors first and thereafter Wealth Migrate and the sponsor.
Exactly as it was shown.
Okay, so that's how it's structured. In order to participate in this project, you would have to have your own LLC in the USA in order to invest in this LLC. It can't be an individual foreign investor that goes directly into the LLC that owns the properties, purely because of the tax administration regarding that. Each investor is kind of responsible for doing his taxes in this space on his own. So whatever he holds his investment vehicle in the US, it can be in his personal name or in a partnership with a husband and wife team, or it can be in an offshore trust, for example. There's a whole host of ways to hold the ownership of the investors LLC. And based on that, we need to be able to work directly with US-based entities for easy tax calculations and easy distribution without any withholding taxes, because the US has some foreign investment, I think it's called FIRPTA regulations, where any foreigner investing into a project in the US would be subject to a 30% withholding on the income for distribution of taxes. So the way we are able to get around that legally is by being able to distribute all of the funds to a US-based entity. So the money lands here, and then from here, the taxes are then calculated based on the ownership of that investor's LLC. If it's owned in your personal name, you'll then pay taxes in your personal name related to how much money you actually earned in the US without having to worry about withholding taxes. And you'll pay, on that income level. And then in terms of if you're based in South Africa or Zimbabwe or wherever else you are in the world, you've got to look at your global wealth and what you need to declare in that country in order to pay the differences between whatever you've paid in tax in the USA and whatever you owe in tax in South Africa for earning that money outside of South Africa. We do have a solution for clients that or investors that are looking to invest large sums of money to hold into a trust structure that's held offshore. We'll have those details ready by Monday morning next week, because I'm personally getting that sorted out for myself. So I think what I'll do here is actually open the floor for some questions. So let me just unmute some people. Okay, do you guys have any questions?
Brendan, just for calculation purposes on our investment earned, do we calculate it on that, the amount of investment you guys are trying to secure, the 5.7 mil?
Is Rob, eh?
I think that's Mike.
Sorry.
It's Mike. It's Mike.
Thanks,
So
Mike.
what I'm saying is, whatever money I put in, I can work out 8% of whatever money I put in. That's pretty simple. But when it comes to the exit strategy, I obviously have a percentage of the entire portfolio. Now, is my percentage based on the money raised or the size of the project?
Your percentage is part of the 5725, which Brendan is pointing out now.
Yeah.
So if you put in $1 million,
Okay.
you just make a percentage out of that. And Brendan's doing it now. In that case, it will be 17.5%.
Out of that, okay. No, that's
Yeah.
And so effectively, Mike, what you can do is you can see in row K, I also put the same figures as in row S, column K and column S. So that would be the percentage or the actual capital per annum that's coming off the project. So you can just take a percentage of that as well, related to your actual size of investment.
Yeah, so effectively, if you put in $100,000 on the project, you'd own 1.7% of it. If you put in $1 million, you'd own 17%. If you put in $2 million, you'd own 34%. So it's directly related to the capital. Yes.
So in this spreadsheet, that's why it's called investor returns. The returns is focused on what was the input money. And if you look at, Brendan, if you go down to row 25, maybe just open that row a little bit. We used basically the internal rate of return here in column S. And then you will see your input money with your output money. So you can actually do that calculation also just scaled to your portion.
Yeah.
Is that okay, Mike?
Yeah, thanks, Michiel. That makes sense.
And then just for a lot of investors can't understand the internal rate of return because they're not used to it so much. So what I also did is I made another type of return, which is something similar to a bank interest rate, and that you will find here on the side in column J23. So that is as if you would have put your $100 in a bank, and you would have received compounded per annum over 5 years, 13.7% interest rate. Just another way of showing it. And then one or two guys also just wants what he gets, what did he put in and what did he get out, and what is that ratio? And that's what we have done in this case, where we just simply say, what did he put in, what did he get out, and what is that ratio? So just to accommodate a few tastes in how to look at the project. And then lastly, we also did it from a total project cost perspective, and that is sitting down here at the bottom, which we call project return. And there you will see actually the yield that we're getting on the project, which is analyzed. So just different ways of looking at, but I think the best way that we've learned is the IRR. And you can see that's pretty much quite a decent return. The big kicker here is that if you take the cost of capital in the United States at the moment is roughly 4%, we actually have almost a 4 times return on that capital, US-based return. We just had a guy this morning which works with international money markets, and he reckons the guys are fighting for 6-7% for this size project. So to him, this is an exceptional return. The second reason why it's so exceptional is compared to a property fund which is listed on the stock exchange, the income is not subject to the actual rate or the REIT's stock market price. It means that if this was a REIT, that 8.5, 8.8, 10% would fluctuate as the actual stock exchange fluctuate. In this case, we're actually completely out of the stock exchange, and we're purely driven by the leases that is secured and our ability to maintain the expenses at a certain level. So that's what we're currently doing at the moment, is focusing on setting a budget for the management agent that would exceed this cash flow expectations as a target. So our value add to this project is that we are going to actually make the cash flow, which we see here in column M, we are going to actually try and increase that. We already saw quite a few places where we can optimize. So the whole idea is that as we progress, we actually would like to get the return up. So our starting point is a fairly conservative point, just to make sure that we can cover our bases. And like Brendan has mentioned, we have included a buffer in the vacancies. And what we're now doing is setting up these budgets so that we can see if we can't even push that even further up. The main reason why we would like to do it, obviously, is a better return for the investor. But as you heard in the beginning, if we can make the income go up, the value of the building goes up, and then we can actually have a bigger equity stake, which we can then refinance to expand the portfolio. So that's actually like a secondary driver for us. And what's beautiful about this is that the sponsor, which is responsible for the management, is in the same boat as Wealth Migrate, which really only gets their money as soon as there is additional profit. So he's actually 100% incentivized to get that cost down and therefore the income up. So that's the beauty of the model that we put together, that the guys that's actually going to manage the expenses on a day-to-day basis is actually going to basically share in the profit. So he's 100% committed to get that down. So therefore our interests are pretty much aligned with the investors, and we actually really only make our money at the end of the project if it's a success. So therefore it's a very long-term commitment from our side. And then like Henny and Scott have said, Henny and some of the other Wealthgrade management is also investing in this project, so they would actually also be investors per se. So from that perspective, it just shows a bit of additional confidence to the project.
Rob, is there anything from your side?
Yeah, Brendan, I was just wondering, are you taping this? Would I be able to sort of download this a bit later? There's bits and pieces I'm missing. And,
yes, I am recording it. So let me just check if it is busy recording. Yes, it's still recording. So what I'll do, I will get it uploaded to YouTube, and I'll send you a link so that you can go through the video again. And I'll also back it up with all of the actual spreadsheets. So I'll send you this spreadsheet, as well as some of the due diligence files on where we're at right now, and the agreement, so that how you actually see your ownership in terms of the subscription agreement into the project. So you can have a read through that.
Yeah, that will help a lot. Yeah, because it's a bit small on the screen. So yeah, that would help a lot.
Okay, cool. So I'll send that stuff through then later on this afternoon, or at least Michiel will send it through this evening. I don't want to make promises that I might not keep.
Yeah, I'll do that.
And then all you guys need to do to come back to us, if you are keen to move ahead with it, is literally just the one piece of paper that's the commitment letter. If you can sign that one, and then the second step would then be moving money to the attorney's escrow account. It doesn't come up to our account. all the monies are pulled into the attorney's escrow account. The attorney acts on our behalf, not on the seller's behalf. This is our attorney's escrow account. If the deal doesn't move ahead for any reason whatsoever, all those monies will be refunded. But we just need to know that it's available to move ahead before our money goes hard on the 1st of August. And that would be the procedure. All subscription agreements and will be signed during the month of August, and they'll be finalized prior to closing. Our closing date is booked right now for the 1st of September, I think it is. So everything has to be signed, sealed, delivered, sorted prior to the 1st of September in order to close. And that would be the procedure that we'd have to go through. Okay, guys, if we don't have any other questions, I think what I'm going to do is call it for the afternoon on that side and say thank you very much for taking the time out. And then I'll send this information through. And any other questions, I'm available on the phone. Michiel's available on phone or on Skype, or just on emails. And yeah, we'll see if we can answer any of them. Just let us know.
Thanks, Brendan.
Thank you. Good night. Goodbye.
Cheers.